Today's journey is all about transforming you from a complete novice to confidently making your first investment. This video is designed to be incredibly beginner-friendly, devoid of complex jargon. By the end of our time together, you'll not only grasp the fundamentals of the stock market, but also understand how to leverage it to make money. So, let's dive right in. Understanding the stock market. Let's use an analogy to explain the stock market in simple terms. Picture me as the owner of a thriving restaurant. As the business flourishes, I aspire to expand by opening another restaurant a few streets away. Just like any growth-focused business, I need more resources, more plates, tables, chairs, and ultimately, more money. Now, here's the crux. There are two primary ways I can obtain the necessary funds. The first avenue involves seeking a business loan from a bank. While this provides an immediate injection of capital, it comes with the downside of repayment, often with interest. The alternative route is going public through an initial public offering, IPO. This entails breaking my restaurant company into shares and offering them to the public. In 2014, Alibaba did just that, raising a staggering $25 billion. This method allows companies to garner funds without incurring debt, providing an opportunity for individuals to invest and become partial owners through purchasing shares, investing in stocks. Imagine you, as an individual, are drawn to my restaurant company. Having scrutinized my accounts, seen the product's potential, and envisioned a bright future, you decide to invest. You buy a share for $10, giving you ownership in my restaurant company. As more people recognize its potential, demand for the stocks increases, driving up the price. Now, you have the option to sell your share at a profit, creating a dynamic market fueled by buying and selling, the essence of the stock market. How to make money. So, why would anyone invest in stocks, and how do they profit? There are two main avenues, capital gains and dividends. Capital gains are akin to the appreciation of a house's value over time. If you buy a stock, anticipating its price will rise, you can sell it later at a profit. Dividends, on the other hand, are periodic payouts from some companies to shareholders, a gesture of sharing profits. While not all companies offer dividends, they can be a steady income stream for investors. Investment strategies. Warren Buffett, a renowned investor, recommends the simplicity of an S&P 500 low-cost index fund. This is essentially a basket containing a variety of stocks, providing diversification and reducing risk. It's a long-term strategy, emphasizing resilience during market fluctuations. Types of investments. There's a myriad of investment options, including stocks, mutual funds, index funds, and ETFs. Index funds, for instance, allow you to invest in a bundle of companies simultaneously, spreading your risk across various sectors or sizes. They're like a basket full of smaller baskets, ensuring that if one company underperforms, others can compensate. For beginners, focusing on index funds or ETFs is a solid starting point, offering a straightforward way to invest in multiple stocks and diversify your portfolio. I hope this deeper dive into the world of investing has been insightful. If you found this helpful, check out another video I've linked here. Thank you, and don't forget to subscribe. Until next time.